We are live now, everyone. Thank you. All the best.
Thank you. Thanks, everyone. Good morning and welcome to the Daily Energy Markets live video podcast from Gulf Intelligence. I'm Paul Hickin, Editor-in-Chief of Petroleum Economist, standing in for the inimitable Sean Evers. Today I've got a great lineup. I've got Dr. Raad Al-Qadiri, non-resident fellow at Centre for Strategic and International Studies. I've got Livia Gallerati making her debut, Senior Oil Markets Analyst at Energy Aspects, and Victor Yang, Senior Analyst at JLC Network Technology. Welcome, everyone.
Good morning.
Now, it looks like oil's going to post its fourth week of gains. It's doing the bull is back in the room in some regards. Raad, if I could get your take on what's driving this and whether you think it's going to last.
Good morning. Yeah, look, I think there are a combination of factors that are driving it at the moment. I mean, fundamentals are certainly playing into it. There is a sort of bullish sentiment that's growing on the basis of, increases in demand. It's certainly got a kick up from some of the latest US numbers, which showed significant draws, and we're sort of heading into peak driving season in the US. But, there are other factors at play as well. And I think one of the interesting things about this is, after all the doom and gloom of the OPEC meeting, whether or not OPEC and OPEC Plus have been found actually to have judged markets well, and some of the doomsayers have been found wanting. But ultimately, at the end of the day, geopolitics matters, various other things matters, but these are markets that are driven by fundamentals, and if this is going to hold into the second half, it'll be fundamentals that keeps it there.
And to push you on that, do you think it's going to hold? Do we see $90 and above anytime soon?
I'm not sure about $90 or much above $90. I think that would take some significant numbers coming out of China, where despite the new SPR builds, there are some questions about demand in the medium term. I think it would probably take a war in Lebanon and the fallout from that to really show the market above 90 for any sustained period of time. But we may bounce around there. Part of the problem is, some of the numbers, there will undoubtedly be short-term numbers that, add a certain bearish pull to things. But at the end of the day, I think we're looking at an oil market that can sort of, for Brent, run between 85, possibly sort of touch 90 for a brief period over the next quarter.
Thanks. And welcome to Livia, who's going to be doing her first one today. But Energy Aspects, we all know, and I've always known them for being a little bit bullish in the oil market. Livia, what's your take going into Q3, Q4? Are we still range bound, or do you see a breakout above $90 a barrel soon?
I think our view is fairly aligned with what Raad has been already pointing out. We don't see prices holding above $90 for a sustained period of time this summer. It's definitely possible that you get spikes here and there above those levels, particularly if you get some big geopolitical headlines or some significant draws in the high frequency data that will come out in the next couple of weeks. But there's a few factors this year that probably mean that we'll be quite range bound in a way that we've already seen in the past couple of months. There is factors to the upside, capping rallying prices, then to the downside, capping any further falls. Obviously, OPEC plus production cuts being the main cap to the downside, but things like government policy when it comes to SPR as well are capping your downside. And we just mentioned China, which I know there have been some headlines that have come out this week specifically on Chinese SPR buying. This is not necessarily new. It's been making the rounds of the markets for a couple of months now. We've known it about since May, I would say. There are some questions about the volumes. At the moment, there's stocks around 60 million barrels of purchases for for the SPR in China, whether that's all in the second half of this year or whether that gets pushed into 2025 as well, or whether it already includes some volumes that have already been purchased in Q1. Still a lot of questions around that. And definitely, I wouldn't rule out that given the current high prices that we're seeing on some of the main benchmarks, they might take their time to purchase some of these volumes. But definitely some bullish support from that coming our way.
Thanks. And Victor, I think this is a nice segue for China. What's your take on how China is influencing the direction of oil prices? One, with SPR buying, as Livin points out, and also secondly, in terms of its macro outlook as well, because it seems to be, it's hard to get a gauge of how underwhelming China's economy is performing. What's your take, Victor?
Well, as Livia said just now, there were a lot of question marks about the SPR purchase. And as you all know, but when the news came out, there was always a push for prices up. But this will not last long. As you may know, China keep its SPR a secret. And you may wonder, well, is this news reliable? And how much are they going to build up the SPR? So I don't believe these SPR reports will support the market much longer. And for the country's actual demand is now recovering in the second half of the year because we had peak refinery maintenance in the second quarter. And refining margins cannot be attractive either because now international crude prices are high and domestic product prices are relatively weak. So refineries have cut their crude runs in the first half of the year. And in April, May, they had their peak maintenance. And in June, Independence still had their peak refinery maintenance. But we are going to see less maintenance in July and August, much less, particularly in August. And jet fuel and gasoline demand is also recovering in summer. So we are seeing a boost in the country's crude demand in the coming months too.
Thanks. Rod, if I can turn to you, you touched on when you first started that geopolitics, a little bit about the rising tensions again in the Middle East, and that could potentially be a cause of breakout. What's your view on where geopolitical risk premium is in the market? Is we saw a bit of news again. It seems to flare up every now and again between Russia and Ukraine in terms of bringing extra risk to the market. Is it how credible is geopolitical risk to shaking this oil market out of its current funk?
Geopolitical risk always has this sort of risk, always has the possibility of shaking the market out of a band. I wouldn't necessarily call it a funk. Prices above 85 are looking sort of relatively healthy, if not sort of overheated. But I think that geopolitics is always going to be a factor, and Russia, Ukraine sort of stands out there if there are any disruptions again, as we saw sort of last year. That could start playing. I think the focus will be on the Middle East, and the focus will be on sort of what happens next. You've got rising tension on Israel's northern border with Lebanon, and worthy Israelis. To put in, to actually implement sort of the rumors that have been spreading in terms of an operation into Lebanon. The ripple effects across the region are going to be inevitable, and it's going to sort of focus tension between Israel and Iran once again. That kind of tension is going to feed into markets and certainly sort of will have a spiking effect. But what it will also do is bring in a level of uncertainty, a level of perception that ultimately you could get a direct war between Israel and Iran, and that is where it starts to matter for oil markets, because that is when you have the risk of potential physical disruptions. That is something that will worry the market considerably. So, let's see what happens. But the signals do not augur sort of a pleasant outcome right now. And it reminds me of, the build up to the 1982 invasion of Lebanon by the Israelis, where security issues on the northern border were used, primarily as a cover to try and alter the status quo in the Middle East more generally. If we're on the cusp of something like that, I think markets are going to feel it, certainly for the initial period of time, and we'll be worried over the longer term that, as I say, you could have this escalation of violence.
Where do you see the calculation, Rad, in terms of if there was this kind of escalation between, whatever more percentage that may be rising as in terms of small percentage, but between Israel and Lebanon, it's where do you see the actual supply disruption? Where does the market perceive a supply disruption? Is it the Strait of Hormuz is the key one, or is it actual outages in terms of production from some particular actor?
Like I think it's this market, and ever since sort of the events of October the 7th, what you have in this market is increasing worries the closer that conflict gets to Iran, because that is seen as the potential source of disruption in supply. So this is not about, an OPEC oil embargo or anything else. This is about physical risk of supply. And I think it comes in two ways. One, that, Iranian oil export facilities could be a target in the event of a direct confrontation and a sustained direct confrontation between the Israelis and the Iranians, as that is a way of hitting the Iranian economy directly. And obviously the risk of retaliation in the Straits of Hormuz, or the risk of any sort of action in the Straits of Hormuz. I think there's been some speculation that the Iranians might strike out at the Arab Gulf producers. I think that's lower down the list of risks. But all of that will sit at the back of I think traders' minds over as long as the conflict is ongoing. And what it means is, the possibility of periodic spikes, periodic, jumps in prices based on events and based on sort of immediate interpretation of events, as opposed to, the actual physical disruption. But where does physical disruption come from? It would come from Iran.
Yeah, thanks. Olivia, if we can bring it back to slightly more focused geopolitics, which is OPEC plus, and your view on how OPEC plus is likely to influence oil markets in the second half of the year. It seems like are the voluntary cuts likely to stay in place? How much is impact are those cuts both taking oil out the market in terms of as a bullish narrative, and how much is the market expectation that some of these cuts are going to come back quite soon, maybe, or is that a perception, and how much is that weighing on as a cap to the oil market bullishness? It's almost two sides to the OPEC plus equation. Is that a fair assessment, or how do you see OPEC plus in the second half influencing oil prices?
I don't think there is much of a likelihood of OPEC bringing back any barrels any sooner than the current plan that it's agreed to. Just think about last year. Like last summer, we had very large draws in global oil markets. And even with that, OPEC didn't accelerate the return of supply in the summer. I think we'll end up being in a similar situation this year. Most market watchers at the moment are expecting large draws in the coming months, and we fall in that camp as well. But OPEC will want to see these draws to happen before it decides anything in regards to its production policy. And of course, they already have production coming back gradually from October this year. So if those draws do materialize in the summer, as we're expecting, that should be enough to sort of start to gradually bring back some production from Q4. If anything, I would say the risk is more in terms of them slowing down the return of some of this production. particularly if demand disappoints in the second half of this year. We're not too concerned about demand generally. I would say obviously China is an exception, as we were mentioning before. There are still some concerns with regards to diesel demand in China in particular, but overall in the rest of the world, and I'm thinking about the US and Europe in particular, we see the worst of the demand situation behind us in terms of the industrial recession that we had earlier this year. So we're expecting fairly robust demand growth this year, about 1 million barrels per day in terms of global liquids demand. So in terms of that, OPEC is probably not going to need to slow down the return of production cuts, but obviously we'll have to see. But overall, not expecting any big surprises from OPEC in the coming months. But of course, the market always has some surprises in store for us. So.
Yeah, OPEC's been, you could argue it must be quite happy with, we're talking how much for stability has been there. Would you say the oil market's been in a sweet spot for OPEC, and even if they've had to do more voluntary cuts and more cuts than they probably would have liked?
I think the price levels that we're starting to see now are probably close to where some of the OPEC producers are comfortable in terms of their budget needs, bearing in mind that we've only just achieved these levels, so they will want to see higher prices for a little bit longer to really, if you feel happy, if this is what we want to say. The problem is that there are still some headwinds in markets, and something we haven't talked about is I've obviously seen a rally the past couple of weeks, but in a way it has maybe come a bit too fast and too quick in relation to fundamentals. We're finally starting to see some of the big draws, particularly in the US and other parts of the world, and the headlines of Chinese SPR buying fundamentally should help markets as well if they materialize. But given how much benchmarks in the Atlantic Basin in particular, like Brent and WTI, have strengthened relative to also to the east of Suez benchmark, so I'm thinking about Dubai here, it does make us a little bit worried that there's going to be a little bit too much crude making its way to the Atlantic Basin over the next cycle, and creating a bit of a glut in a way similar to what we've seen also in this spring in particular, where there was a lot of crude building around Europe and the US. If this does happen, it probably means that prices need to correct a little bit lower before a more sustained rally can ensue, from the next cycle onwards.
Interesting, thanks. Victor, if I can bring you back in terms of the China question, because China's the demand center that often OPEC hangs its hat on. It's been a surety of China's demand growth over the recent years, and not only has that potentially a little bit dried up a little bit more than OPEC and some of the oil producers would have liked, but also there's a danger that it could be the shape of things to come if we believe the hype around electric vehicles that are happening in China and etc. What's your view in terms of how much oil demand will grow and sustain from China, and both in terms of the trend going forward now and maybe a little bit further out?
Yes, well, and yes, it is indeed a good question about the electric vehicle and other, alternative energy impact on diesel and gasoline. And particularly diesel, as Livia said earlier, is a bigger concern than gasoline because of the contrast between natural gas and diesel. There's a significant advantage of natural gas over diesel this year, and the sales LNG powered truck has surged in China, and this is making more inroads into diesel demand. So we are actually seeing a modest decline in the country's diesel demand so far this year. And for gasoline, we have seen an increase because despite the increase of big NEVs, the sales of conventional fuel vehicles is still growing. So on the whole, demand for gasoline is still rising. And jet fuel demand has actually surged this year because of much more travel. Just take international travel, for instance. In the first 6 months, international travel, foreigners entering China surged by 157% because of China's visa-free policy. So this has pushed up jet fuel demand quite dramatically. And international demand, international front is also recovering this year apart from China. So we are not seeing the peak of China's fuel demand yet, but diesel demand is largely flattening out. We will continue to see growing demand for gasoline and jet fuel in the coming several years until around 2027, 2028, particularly for jet fuel demand.
Well, thanks. If we can turn to the survey question we've got for today. We're going to look at a little bit on some of these oil price influences, and since we're going on to a bit of a summer break for golf, we're going to go to a bit of a small hiatus. I think it's a good opportunity for us to look at what are the key influences going to be shaping the oil market in the second half, and what could really change the market from its current sweet spot. But while Medlin is looking to bring that survey question up, Aisha's got it there. If you can vote. And while Rod, if you can, some of the other influences that we could look at in terms of in the second half of the year is, obviously we've just had a UK election here in where I am, a big shift to Labour from the Conservatives, and what that may mean for energy policy. But more generally, it seems like across Europe recently we've had elections where there was a little bit more of alert to the right. A lot of talk that Trump may win the US elections. It plays out the idea of, again, how much the West sees energy security potentially versus sustainability, at least on one element of the election side of things. How do you see the political spectrum and elections that have been shaping up in terms of what that could have influence energy policy and oil policy going forward?
I think, in the short term, and that the change in the electoral landscape is probably unlikely to have a major impact on oil prices, certainly for the rest of this year, and even going into next year. I think where it starts to be important is over the issue that you mentioned, which is, what is the pace of the energy transitions that's taking place, and to what extent will you see, certainly in Europe, some of the ambitious goals being gummed up, and in the US, to what extent would a Trump administration, Trump 2.0, be a threat to the Inflation Reduction Act and the US effort to use green industry and developing green industry as part of a reindustrialization process? I think, you're already, I think in the European case, sort of what you've seen is obviously the sort of hard right make gains, but the center still hold. I think what it points to is people, are people willing to pay the price of energy transitions, and particularly very ambitious energy transitions? And just in the last couple of weeks, we've seen news of airlines talking about having to increase or add fees for sustainable aviation fuel. You've seen some sort of discussion in terms of diesel prices and carbon mandates on diesel, starting to increase the cost of that as a fuel moving forward. And I think this is where it's playing out. It's less in terms of the oil markets immediately, although ultimately will have an impact on demand and probably on supply in the longer term. But it's rather our population's willing to pay the price of energy transitions. And you have to say that the sort of case of Europe would suggest that environmental policy and strict environmental policy is something that constituencies and publics are pushing back on, at least parts of them are pushing back on, in the face of wider economic challenges and in the face of cost of living challenges. In the US, it's more a cultural war. The irony is that the Inflation Reduction Act has probably benefited Republican states more than it's benefited Democratic ones. But nonetheless, in a period of hyperpolarization, it's associated with a drag on the US economy and a threat to US energy security, which is, in practical terms, hard to prove or sort of seems to sort of run counter to the data that exists. But so I think that's where you're going to see it. It won't be immediate. It will be in the longer term. And it will probably impact supply as much as it impacts demand, because I think some of the restrictions, certainly in the US, that the oil and gas sector feels that it faces may be eased. And what you're seeing in Europe, and certainly with some of the big super majors in Europe, is a shift towards a focus on hydrocarbons in a way that sort of perhaps 2 or 3 years ago wasn't the trend and wasn't the pattern.
Victor, I can ask you if I can jump to you just quickly on that point, because China is one place where almost the security goals are aligned with sustainability goals, which is moving away from weaning itself of its huge oil imports. How does China view the transition in terms of, is it a security goal for China, or is it a sustainability goal? How much is this shift to electric vehicles one or both of these aspects, Victor?
Yes, well, and here in China, the transition to clean energy is, administered by the government. So it means that all the industries will move towards that direction. That's the big difference than other countries. It's not like, say, for the photovoltaic industry, for instance, it's not making money. If in other countries, it would be shut down. But in China, no. If it's the industry the government wants to develop and it wants to move in that direction, it will support these industries with same fund, with same strength. So these new energy industries will move forward. So there will be no coming back. This will be a sustainable target for the future, because the country is moving towards greener and more sustainable development. So it's a long-term target.
If we can bring up the survey results of the survey. So interesting that China is a big factor. If I can leave the final thoughts to Livia, to get her sense, if you get your thoughts on the anecdotal and initial results of this survey question. What do you see as the biggest drivers in the second half? Do you agree with this survey so far? And are there things that we should be looking at that aren't included on this survey?
So I think China probably has is the most popular choice, because to me, at least, it's the biggest unknown in terms of what the second half of this year oil markets might look like. Particularly in terms of demand, is the one pocket of the market that we are worried about the most, and not just because China is one of the biggest demand centers, right? In terms of what else we might be looking at, obviously government policy, and we've covered this already, how it will shape up in the coming months is important, and not just in terms of SPR, and here the US comes in as well, because the US government has been very proactive in its use of SPR, both in terms of buying and selling. And should oil prices, and particularly gasoline prices, really spike this summer, the current US administration has been quite vocal about its openness to using SPR and other tools to try and keep prices in check. So I think that will be another thing to watch. OPEC Plus, not expecting any big surprises, but we'll have to see. And of course, there are still a lot of geopolitical risk. We've covered Israel, Russia. The Russia-Ukraine war has fallen a bit in the background recently, but I don't think the market should be too complacent in terms of the continued risk to Russian energy infrastructure from Ukrainian drone strikes. We've seen a lot of attacks on refineries for now, but they're starting to target port infrastructure as well as infrastructure along pipelines. No real impact to supply yet, but it is still a risk for the summer, and definitely something that we will be watching very closely.
Thank you so much. I just want to say thank you so much to all our guests today. Dr. Raad Al-Qadiri, non-resident fellow, Center for Strategic and International Studies, Libya Galarati, Senior Oil Markets Analyst at NG Aspects, and Victor Yang, Senior Analyst, JLC Network Technology. Thanks, everyone.
Thank you.
Thank you.
Thank you very much.